Schedule D.
Hi, welcome back. I'm going to talk a little bit further about Schedule D. We mentioned it earlier, capital gains and losses. And these are events that don't happen every day. It could be once every few years. Usually it's a major event, or if you're in the markets, you might be getting them every year if you're trading stocks. But Schedule D is where these capital gains and losses are reported, and they do offset. Right off the bat, I will tell you that losses are limited. If you lose $50,000 in the stock market, you can only deduct up to $3,000 in a year. What happens to the extra $47,000? It just carries forward. So the next year you might make $60,000. You get to use up that 47 and you're back in the game, so to speak. You're revenged, you're vindicated. You've got your losses offset. But I have some clients who lost a lot of money in the early 2000s or 2008 that are still rolling that 3,000 forward. They just haven't overcome it. But there's no limit on gains, obviously. So with the capital gains and losses report, it's broken up into two parts, Schedule D, short-term, long-term. Short-term is anything that you've held less than a year. So if you bought it in February and you sold it in December, it goes in the short gain department. If you bought it in November and sold it the following year in December, long-term, more than 1 year. It doesn't have to be a whole calendar year, but just within a whole year. Why do they make that difference? Because long-term gains and losses, generally held more than 1 year, are taxed at a lower rate. And that could be a big deal for many investors and people who hold on to a stock for 5, 10 years or 3 years, or a house or a piece of art or something. That gain of when you sold it will be taxed at 20%. So you get the dates right. And actually, the schedules behind this are, you have to put in your purchase date and your sale date. And often if you are in the stock market, the brokerage company will give you a form called 1099-B, and you can just work right off that and put the totals in depending on where it is, and make a notation, refer to the form 1099-B. 8949 is a sub form of that. And if you are not in the market per se, but you have other gains, there's a form 4797 if you're selling business property, a car or a piece of machinery or a building or something that's not in the securities market. That'll be reported in 40, and it has the same rules, long-term, short-term. So the issue for a lot of taxpayers is they may not know their basis. And basis is a big word. I'm going to write it out right on here, basis. And the basis is what you've paid for it plus what you've added to it. So for instance, if you bought a rental property or even your home, if you bought a home for $500,000 and now it's being sold for $1 million, does that mean you have a $500,000 gain? Yeah. Other than if you added more money to it, say you built out a deck or a second bedroom. So instead of saying I paid 500, maybe you spent 580,000. Maybe you added more money to it. So that increases your basis. So whatever your basis is, you want to remember that, documented, because it's not something you might know. It might have been years ago. So you want to record all of your purchases that increase your basis. So when it comes time to sell, that gets added to it. The other thing that you can subtract from your proceeds is commissions or fees or selling expenses. So that's on the other end. You might have sold it for $1 million, but maybe you pay a broker 55%, $50,000, and you had selling expenses. So that will come off your cost. So these two elements, it's not just the start and the end, but if you added to it or you had expenses that helped you sell it, those are also factored into it. But at the end of it all, Schedule D can be a big number. And of course, if you lived in a home and you sold it, you can exclude $250,000, or if you're married, 500,000. If you lived in it for 2 years or more in the last 5 years. So this is a good break for a lot of people that just don't have to pay tax if their gain is more than 500, but they've lived there for 2 to 5 years. So study this, study your records. When you give them to your tax preparer, you want to be able to explain where you're getting these numbers from. And when you sell something like a house, they're going to give you a 1099-S, which means sale. You want to have that from your escrow company, or a 1099-B from your brokerage company. And all of these are just what you received. What you paid for it, no one's going to give you that document. That's on you. So you have to go back and figure out how much you paid for it. Often the brokerage companies will provide your costs, but sometimes they don't if you've changed brokerage firms. So it's a fascinating form in terms of like accuracy, and if you can work it and really increase your basis and reduce your fees, you can often get away with paying the minimum tax based on your actual gain. So we'll talk a little bit more about some of these other nuances in Schedule D.